Hello, I'm John A.G., and there's a moment that arrives before disruption, before volatility, before anything visibly breaks, where everything still looks stable enough to trust, but not stable enough to explain. It's the moment when prices behave normally, commentary sounds measured, and confidence feels justified, yet something underneath has already shifted. Most people never feel that shift directly. They sense it later as confusion, as the quiet shock of realizing that what they relied on didn't fail loudly, it simply stopped working when they needed it most. Silver is sitting inside that moment right now, not because of a single data point, not because of a dramatic headline, but because the internal balance that has kept this market contained for years is no longer behaving the way participants assume it should. For a long time, silver has conditioned people to expect disappointment. Breakouts stall, rallies fade. Every attempt higher is met with resistance that feels inevitable. That pattern has been so consistent, it has become psychological infrastructure. People don't just trade silver, they trade the memory of how silver usually behaves. That memory is comforting. If you believe nothing meaningful ever happens, you don't have to prepare for change. You don't have to consider extreme outcomes. You don't have to question whether the forces controlling price are still willing or able to do so. Comfort in markets is rarely about safety. It's about familiarity. And familiarity is dangerous when conditions evolve faster than perception. What's unfolding now doesn't feel dramatic on the surface. Price is compressing, moving within a narrowing range, oscillating just enough to keep attention without provoking urgency. Compression feels boring. It feels like indecision. But compression is not neutrality. It's stored pressure. The tighter the range becomes, the more effort is required to keep price inside it. Eventually, containment stops being efficient. The false comfort most people rely on comes from the belief that there is always a stabilizing force behind the scenes, that market makers can guide settlement, that liquidity providers can smooth volatility, that price can always be nudged toward a level where nobody gets hurt too badly. That belief has held often enough to feel structural. But structures are only real until the incentives supporting them change. One real mechanism matters more than almost anything else here, and it operates regardless of opinions or narratives. It's the concentration of options exposure into a narrow time window. Options are often treated like side bets, but in reality, they represent future obligations. When those obligations pile up on both sides of the market, price stops being a reflection of belief and becomes a trigger for forced behavior. Under normal circumstances, there is a zone where those obligations offset, a level where losses are minimized and hedging flows remain manageable. That zone is what people unconsciously assume will always exist. But when positioning becomes too large and too polarized, that zone disappears. There is no safe settlement price. Any movement creates more movement. If price moves higher, dealers who sold calls must hedge by buying futures. That buying pushes price higher, forcing more hedging. If price moves lower, the same dynamic works in reverse through put exposure. In both cases, feedback loops replace balance. The market doesn't decide direction based on value. It reacts based on obligation. This is why the most important question right now isn't whether silver is bullish or bearish, but whether the structure that has suppressed magnitude can still function. Because once those feedback loops engage, direction becomes almost secondary. What matters is speed and scale. Behind this sits a risk that doesn't announce itself clearly. It shows up as small changes that feel insignificant on their own. Commercial traders who for years have provided consistent selling pressure have been reducing their short exposure. That doesn't feel dramatic. It doesn't move price immediately, but it matters because it removes the assumption that someone will automatically lean against rallies. At the same time, speculative positioning has been reduced through volatility. The leverage that usually fuels sharp sell-offs has already been shaken out. That leaves fewer forced sellers on downside moves and fewer participants willing to press price lower aggressively. When selling pressure weakens quietly while structural triggers remain, markets become asymmetric without advertising it. History doesn't offer clean comparisons here, but it does offer a warning about mechanisms. Periods where paper pricing diverges from physical reality can last longer than expected and then resolve far faster than people think possible. The resolution rarely starts where people are watching. It starts where stress accumulates silently. Physical silver markets are showing that stress through persistent premiums and declining inventories across multiple exchanges. Not one location, not one region, but globally. That matters because it limits flexibility. The system's ability to respond to pressure by shifting metal from one place to another is shrinking. When buffers thin, small shocks travel farther. This tension doesn't immediately force price higher. Instead, it creates a standoff between paper markets that can trade claims endlessly and physical markets that deal with finite supply. That standoff is stable until it isn't. When confidence shifts, it does so unevenly, hitting certain funds, regions, or products first. Those early fractures are often dismissed as isolated issues until they aren't. Recent dislocations in Asian silver investment vehicles are a signal of what happens when access becomes constrained and price stops behaving as expected. Export restrictions, licensing limits, and domestic hoarding reduce global availability even if headline supply numbers look unchanged. Paper markets can ignore that for a while. Delivery systems cannot. Layer macroeconomic uncertainty on top of this, and the structure becomes even more fragile. Interest rate expectations, inflation data, currency movements all act as catalysts, not causes. In a balanced market, surprises are absorbed. In a compressed market, surprises choose direction. Technically, silver reflects this tension through narrowing swings and declining volume. That combination is often misread as disinterest. In reality, it reflects waiting. Waiting for resolution. Waiting for confirmation. Waiting is fragile. Once price moves decisively, waiting turns into chasing. What changes how you should think about this moment is realizing that neutrality is no longer neutral. Doing nothing is still a position. Assuming stability is a bet that the mechanisms which enforced it remain intact, even as the incentives supporting them erode. The next phase will force resolution, not because someone decides it should happen, but because the system can no longer sustain containment. Price will move to a level that resolves obligations, inventory stress, and confidence gaps simultaneously. That level may feel irrational in hindsight, but it will make perfect sense to the forces that pushed it there. The unsettling question to sit with as this begins is not where silver is going, but this. When the move finally starts, will it feel like confirmation of something you understood, or the moment you realize the framework you trusted was already outdated before price ever told you so? Once you accept that containment itself is starting to fail, the market looks very different. What once felt like a tug of war now looks more like a system running on delayed reactions. The important forces are still there, but they're no longer synchronized. And when incentives lose alignment, stability becomes an accident rather than a feature. One of the most underappreciated shifts happening right now is how control quietly migrates when dominant participants change behavior. For years, commercial traders acted as a predictable counterweight. Their presence didn't just influence price, it shaped psychology. Traders learned that rallies would be sold, breakouts would be faded. That expectation became embedded in strategies, risk models, and even emotional responses. But expectations only protect you when they're still valid. As commercial short exposure has been reduced, the effect isn't immediately visible on a chart. Price doesn't explode just because someone stops leaning on it. What changes first is response time. Moves that used to stall now extend a little further. Pullbacks that used to attract aggressive selling find fewer participants. Liquidity doesn't vanish, it thins. And thinning liquidity is where outsized moves are born. This is where second-order effects begin to dominate outcomes. The absence of expected selling pressure changes how other participants behave. Sellers hesitate, unsure whether resistance will actually hold. Buyers delay less, fearing that waiting means missing. That shift alone doesn't cause a breakout, but it removes the friction that normally slows one down. When friction disappears quietly, acceleration feels sudden. At the same time, physical market stress continues to work in the background, largely ignored by paper traders until it becomes unavoidable. Persistent premiums are not a curiosity. They are a message. They say that access matters more than quotes, that delivery matters more than settlement. When that message repeats week after week, behavior adapts even if price does not. Inventory drawdowns across major exchanges deepen this tension. Each reduction narrows the margin for error. In a system designed around flexibility, buffers are everything. They allow markets to absorb demand spikes, delivery requests, and logistical delays without visible disruption. When buffers shrink simultaneously in multiple locations, the system becomes brittle. It still works, but only as long as nothing unexpected happens. Unexpected events don't need to be dramatic to matter. A delayed shipment, a surge in delivery notices, a sudden increase in regional demand, any of these can force decisions that ripple outward. And once decision-making replaces routine process, volatility follows. Markets are efficient when they operate on autopilot. They are unstable when they have to think. China's position adds another layer of fragility. Restrictions on exports, limited licensing, and growing domestic demand reduce the amount of metal available to global markets regardless of headline production figures. This doesn't show up cleanly in supply statistics because it's not a production issue, it's an accessibility issue. Silver can exist and still be unavailable. Paper markets treat those two states as equivalent. Physical markets do not. When dislocations appear in investment vehicles tied to that system, they act as stress tests. They reveal where access breaks down first. The collapse of confidence in one product doesn't stay isolated if the underlying constraint remains. Investors look for alternatives. Alternatives increase pressure elsewhere. Pressure migrates until it finds a release. Policy responses often intensify this process unintentionally. Measures meant to calm domestic markets can tighten international conditions. Attempts to stabilize price can reinforce perceptions of scarcity. Even reassurance can backfire when participants are already primed to question availability. In such environments, trust becomes fragile not because information is missing, but because too many signals conflict. Overlay macro uncertainty, and the structure becomes even more unstable. Interest rate expectations shift. Inflation narratives oscillate. Currency strength fluctuates. In a balanced market, these forces offset each other. In a compressed market, they don't cancel out, they choose direction. A single catalyst can tip the structure because the structure is already leaning. Technically, this shows up as narrowing ranges and declining volume. Many interpret that as disinterest. In reality, it's anticipation. Participation hasn't vanished, it's waiting. Waiting for confirmation. Waiting for failure. Waiting is not passive, it's tense. And tension resolves abruptly. This is the point where thinking has to change. The question is no longer whether silver is undervalued or overvalued. It's whether the current configuration can continue without forcing adjustment. Markets can tolerate mispricing for long periods if the mechanisms enforcing it remain intact. When those mechanisms weaken, repricing becomes mechanical rather than analytical. A useful mental shift here is separating volatility from danger. Volatility is visible. Danger is structural. A calm market with failing supports is more dangerous than a volatile market with functioning ones. Another shift is separating exposure from ownership. Exposure can be repriced instantly. Ownership cannot. When systems transition, that difference matters. Watch who is forced to act. Forced behavior reveals pressure points. Options hedging, inventory management, policy intervention all create obligations. Obligations don't wait for consensus or clarity. They execute under constraint. That's why moves tied to structure feel disproportionate to the news attached to them. As price approaches widely watched levels, reactions will be amplified not because the levels are special, but because behavior clusters there. When clusters break, strategies built on containment fail together. That failure produces urgency. Urgency feeds momentum. Momentum feeds narrative. Narrative arrives last. What's unsettling about this phase is how little warning there is between recognition and reaction. By the time price confirms a move, the conditions that enabled it are already exhausted. That's why preparation matters more than conviction. Preparation acknowledges uncertainty. Conviction resists it. Signals in the coming window will feel contradictory, strength alongside stress, calm language alongside sharp movement. These contradictions are not noise. They are symptoms of transition. Markets in transition rarely make sense through frameworks built for equilibrium. The unresolved tension beneath everything is simple but uncomfortable. Can a market built on paper claims continue to function smoothly when physical constraints tighten and traditional suppressive forces retreat at the same time? The answer won't be delivered as an explanation. It will be delivered as a move, and when it is, it will force everyone involved to confront whether their sense of safety came from reality or from patterns they assumed would never change. When the move finally asserts itself, the most important information won't come from the size of the candle on the chart, but from how behavior changes around it. Markets reveal stress not through price alone, but through reaction. Who hesitates? Who rushes? Who disappears? Who is suddenly forced to explain actions they didn't expect to take? Those reactions expose where confidence was real and where it was borrowed from habit. The first thing that usually breaks is narrative discipline. Commentators rush to label the move, not to understand it. If price rises sharply, it's called speculation or excess. If it falls sharply, it's framed as proof that nothing was wrong. Both explanations miss the point. Structural moves don't care about labels. They resolve imbalances that narratives were hiding, not addressing. This is where confidence fails quietly, not in panic, but in reassessment. Participants begin to realize that the assumptions guiding their decisions were never tested under these conditions. Models built on stable liquidity struggle when liquidity thins. Strategies built on predictable suppression falter when suppression weakens. The failure isn't dramatic. It's disorienting. People feel late to a realization they didn't know they were missing. Second-order effects accelerate this process. If silver moves sharply higher, the conversation immediately shifts from price to access. Dealers reassess inventory policies. Buyers who were comfortable waiting suddenly care about delivery timelines. Premiums widen not because demand explodes overnight, but because risk tolerance collapses. Nobody wants to be the last one relying on smooth settlement. If the move is lower first, the reaction is more complex. Lower prices don't immediately create relief. They create doubt. Sellers hesitate, unsure whether lower quotes actually improve availability or simply reflect forced paper selling. Buyers hesitate too, waiting for confirmation that the move isn't temporary. That hesitation compresses liquidity even further, increasing the odds that the next move is sharper, not calmer. Policy responses lag behind these shifts and often intensify them without intention. Efforts to reassure markets can be interpreted as validation that stress exists. Restrictions meant to preserve stability can reinforce perceptions of scarcity. Even silence carries weight when participants are already primed to question smooth functioning. In transitional moments, every action and inaction is interpreted through a lens of mistrust. The practical reframe at this stage isn't about tactics, it's about perspective. Understanding that price is not the system, it's the signal the system uses to adjust behavior. When systems transition, signals become louder because adjustments need to happen faster. Volatility increases not because markets are irrational, but because they are efficient under new constraints. One mental rule that becomes useful here is to watch friction instead of headlines. Delays, premiums, widened spreads, changes in contract terms. These are not noise. They are evidence that price alone is no longer resolving demand. When friction rises, volatility usually follows because markets seek the fastest way to reduce resistance. Another rule is to observe who is forced to act. Voluntary behavior is slow and reversible. Forced behavior is fast and final. Options hedging, delivery obligations, inventory decisions, policy interventions all create force. Force reveals structure. Structure determines magnitude. As the silver market moves through resolution, familiar reference points lose relevance. Support and resistance levels matter less than response quality. Does participation expand after a break, or does it thin? Do physical markets follow price or diverge further? Does confidence rebuild, or does caution deepen? These answers tell you whether tension is being resolved or simply relocated. What catches many people off guard is how quickly sentiment flips once a threshold is crossed. Skepticism becomes urgency. Patience becomes fear of missing out or fear of being trapped. Those emotional shifts feed directly back into mechanical processes, amplifying moves that were already structurally driven. By the time calm analysis returns, the environment has already changed. At a deeper level, this moment is not just about silver. It's about how trust functions in markets built on abstraction. Trust that contracts will settle smoothly. Trust that liquidity will appear when needed. Trust that prices reflect reality closely enough to guide decisions. When that trust weakens, even temporarily, markets reprice more than assets. They reprice assumptions. Silver sits at a sensitive intersection of industrial necessity, investment demand, and strategic interest. Industrial users care about continuity. Investors care about protection and optionality. Policymakers care about security and supply chains. When all three perspectives tighten simultaneously, price becomes a secondary output rather than the primary driver. What happens next will feel obvious in hindsight and uncertain in real time. Structural moves rarely announce themselves cleanly. They unfold faster than understanding can keep up. The participants who appear calm afterward are rarely the ones who predicted the outcome. They are the ones who accepted uncertainty before it arrived. The unsettling question to leave open is this: if the coming resolution forces a repricing not just of silver, but of confidence in the mechanisms that kept it contained, what other assumptions tied to stability begin to unravel alongside it? And if those assumptions have quietly shaped behavior for years, how many people will only recognize their dependence on them after they're already gone?